Good afternoon, everyone. Brett Crowther back with you with Charles Schwab. And hey, I'm glad to be back. I missed last week, but hey, back again this week after a bout of some illness last week, anyhow. And we got some things to cover. We got a lot to cover today. We're going to be looking at, some of the homework I talked about 2 weeks ago, how those things have played out since then. We're going to talk about earnings and short verticals, the good, the bad, what to do about it. We're going to look at some of the trades, what I've done with them since the last time we talked. We're going to look at some potential candidates for some paper trades. There's just a lot we're going to get into, hopefully a lot of information to cover that will help all of us understand short verticals and the application a little bit better. So let's cover some disclosures before we get into the meat of it, though. Do remember that options carry a high level of risk and are not suitable for all investors. Information here is for general information purposes only, should not be considered as a recommendation to buy or sell. Paper money application is for educational purposes only. Short options can be assigned at any time, regardless of in, out, at the money. Doesn't matter. It can be assigned at any time. Very important concept. Past performance is no guarantee of future performance. There's also the option Greek definitions in there. We will use delta a lot of times, sensitivity to the option change the underlying asset. Then the stop orders, don't tend to use those a lot. I will from time to time, but just note that if there is a stop order, that it doesn't mean you'll get executed. Your fill price may not be exact same as your stop price. Okay. So, good to have everyone with us. Chris, Will, Mighty Mouse, Richard Judge, Tammy, JD, a lot of you, welcome back. Good to be with you. Thank you for joining me. I really do appreciate everyone who joins me on these classes. It's so fun to have them week to week as we analyze the market. We analyze what's going on out there. We analyze the trades, and we follow them week to week so we can see the application of this information, which is, I think, it's so vital. It's not just about talk about the concept and then, goodbye, good luck. It's let's apply it. Let's see what it is in a bullish market, a bearish market, a neutral market, and how do we adapt and adjust to those various conditions? And like I mentioned earlier, one of the things we'll have to adapt and adjust to today is earnings, because we have a lot of earnings going on. And so we need to, talk about how to deal with that. So let's do this though. Let's start off with, let's take a quick look at the SPX, and I just want to get your gauge. What do you say the trend of the SPX is? I want to hear that from everybody. What type that in. What do you say it is? And then we'll take a quick look at this and see, using the SPX as kind of a gauge for the overall market, right? Like what's going on. We can look at the NDX and the DJ and stuff like that, Dow, everything. But I really just want to take a quick moment and look at the SPX and then go from there. And so today, what do we have? We're off. It's coming back a little bit. It was off a little bit more. It was off about 1.3%. It's only off about 1.5%, or 05, I should say, percent now. So just down about 1%, but still, off. Okay. So I got a neutral, we got small uptrend, we got choppy. There's a lot of correct answers in there. Drifting up to sideways. Okay, neutral for the year. Okay, good. I like all the different responses and stuff. Says neutral. So I think where people are coming from, and here let's draw this out together, shall we? So if we're looking at highs and lows, we have a low here, a high here, a low here, a high here, a low here. And this is maybe a little too fat, but we're kind of getting a lower low here, but we're still getting a higher high, and then we're kind of getting equal or similar lows and then a lower high. And so overall, before this, in this area, in fact, let me just change colors. We'll get this just a little bit thinner. Maybe back in here is more of an uptrend as we were making those higher highs. But when we started to make that lower low right there, this is where some people are saying, well, it's got that upward, trend, a little bit more neutral though, because maybe not necessarily making those higher lows, and the highs are even starting to dip a little bit. Okay. And so I see consolidating, good one for that. Not a good day, says Harry. Well, it's interesting because for those of you who've been to this class week in, week out, what typically happens when I teach this class? Just what has happened, maybe not typically, but what has happened the last couple of times I've taught the class. Maybe you want to go back and look at what's happened. There's giant gamma exposure, that 7,000 that acts as the ceiling, says Lewis. Yes, definitely. We can see some technical aspects of that. Let me erase all this, and we'll we'll just draw that in. Let me get back to just our regular stuff here. So, mentioning, okay, there's some resistance back up in this ballpark, right? Yeah, so there's definitely some resistance that it's been struggling to break through, and every time it gets up near that ballpark, it's been, dropping back down, almost forming like a channel in a way, right? Like, and that's where we get the consolidation going on, and we'll have to watch that. And I want to actually bring up something about channels. I did a YouTube short about this not too long ago, and I'll just show you. In fact, let me show you that right now. Let me pull this over. Let's see, where is it? Grab this right here. What I want to do is I want to bring up this. This is our Trader Talk. You're familiar with this, right? Our Trader Talk YouTube page where we have our webcasts, and we, when we teach these, we record them. We like to post them. We get them up as soon as we possibly can. Some, if there's too many adjustments we have to do to it, they don't get up. But most of them we are able to post, which are under playlist. And so you'll see, even the short verticals class that I do, you'll see that in here. We can see all the different types of topics that we present on, we teach on. There's a lot of them out there, but this will have them all in there. One of the quick ways to actually find it is you can just type in, up here it has a search tool. If we just do short verticals, maybe vertical should work. That'll bring us to a lot of the classes that deal with that. And so there's a whole bunch of them. I've just been teaching this more recently, but that's just a quick way to find a bunch of them that are out there. Or you can, go through here and also find where our short verticals are listed. I think it's usually down right about somewhere in here, if I'm not mistaken. It got updated, so it's moved, but it was right here. Anyhow, I'm going to take the time I can't spot it with my quick eye, but it's in there somewhere. I'll have the short verticals. But here's another thing I want you to look at is next to not just short verticals, but shorts, actual YouTube shorts, right? So in there, I talked about using channels right here. Use channels to help identify support and resistance. Go give this a look. Check that out. These are under 3 minutes. In fact, here's me in a different spot looking a little different, right? So actually my basement, filming that one, but check these out. They're just real quick, good information on specific topics that, you can just get some nuggets from and move on. So something there that hopefully will help you out. But like I said, please, give that a look. It'll help, I think, you get a better understanding of some of the things I don't have time to go through in the class, and going through this channel is one of them. But so the market overall going a little bit sideways, right? And so, typically we're looking at these trades that are, neutral to bullish. And so generally speaking, it should benefit our trades, but then the thing is not every stock will follow the overall market. One thing to consider is, it really depends on what is moving the market. Because we often think, well, the market's up, stocks are up, but it's not necessarily the case. Maybe some major, huge market cap stocks have moved up. And sometimes you can have a situation where only like the top 5 or 7 stocks had major moves, and the rest of them really didn't do that much. And so you could have even a situation where most stocks went down, but since the very few but very large stocks moved up, the overall weight of the market came up. And so something to keep in mind. But it does give us a general sense of where the market overall is going. And so with that, last time we talked, which was 2 weeks ago, and by the way, I really appreciate Cameron May, who's, has helped me out. He's doing the chat right now. He does a fantastic job. Great friend. We've been hanging out for about 20 years, and so we know each other well, but I appreciate him handling the chat and also filling in for me like it was the last minute when I woke up very ill last Thursday. So thank you, Cameron. But let's do this. When I was last here, we talked about a couple stocks, and I just want to come back and revisit those and say, okay, well, what has happened since then? Because I left these as a homework assignment to keep an eye on, right? And say, because when we had our class, like for instance, this is when we had our class last time I talked about this, and I left this as a homework assignment. We had this Fibonacci retracement where it came down, it bounced up, but it rolled back over and noted it hadn't quite made it up. I said, okay, let's watch this and see what happens. Will this break through and continue on down, or will this, find some support here and rally back up? Well, 3 days after our class, it did in fact break, and it's actually dropped down a bit since then, even reaching a potential target area down in there. And by the way, I do, in those shorts, I talk about how I modified these Fibonacci's, how I went out and applied them to the chart. So go look at those YouTube shorts and I'll talk about just all these things about the Fibonacci's and how I set them up and applied them to the chart. But so that was one, maybe I should have taken a paper trade on that for the class. It's just, I like to do things here together, right? I like to wait and do things with you all. It's so much more exciting for me. And I think it's better as a teaching example if we look at it together instead of me just doing it and said, oh, by the way, the other day I did this thing, something. So generally I'll wait. Now, at times I do make some moves, and I'll go through one or two today that I just made some moves on. But let's look at another one I talked about, which is Tesla. And Tesla was interesting because we were looking at this, pretty solid support level. It had a little bit below it right there, but it was mostly holding the support level. And this is the day we talked about it. We said, let's see what happens here. Let's see if it holds again. And if in fact, Tesla can bounce off that support level. Well, guess what? Someone forgot to plug it in. It didn't get charged, and down Tesla went, right? So it dropped down. Now we got a different situation forming here. Now, really, this support level is kind of losing favor because it hasn't held more recently, right? And this is becoming maybe a more significant level of support down here, where we've seen it bounce a couple times, some consolidation in that area, and the most recent bounce with the doji candlestick. We almost have a morning star formation, big red candle, doji in between, big white candle coming. It should be about, halfway, at least halfway of that red candle. And so, this is kind of a questionable morning star. However, that would be the idea behind the morning star, saying it should rally back up. And indeed it did from there until it's looking like it's having a little hiccup today. But so this one did not bounce as we were anticipating, but that was kind of the point of waiting and watching, and not just saying, okay, it's at support. How about, let's go ahead and place a paper trade right here. Let's wait to see if that bullishness comes back in. And then the last one that I want to bring up that I left you with as a homework assignment to keep an eye on was very similar to that, in the sense that now this had been in a downtrend, and we noted that the downtrend had been turning around, meaning it was making, actually, let me get the dot here. Let's do this. It was making lower lows, lower highs, right? Going like this. But then it broke right here, and right there, it made a higher high, so wherever it turned around, it hadn't turned at that point, but wherever it turns from there, it would be higher than this previous one over here. And so now we start to see that weakness in the downtrend. It hadn't reversed trends, but then we get this spot where it rolled over, came back down, rallied up from there, and now we're getting higher lows and higher highs. And so now we're seeing a reversal of that long-term downtrend. Here's a long-term resistance line on a trend that it broke above, and so it's breaking above all sorts of different areas, telling us that the technicals are shifting. This is a change from bears being in charge into the bulls potentially taking over. And this is where we had our class right here. We said, okay, let's watch and wait. It hadn't, fully decided what it wanted to do, but I said, hey, I'll leave you with that one to watch. And again, possibly paper trade, short verticals, the concepts we're teaching. And in fact, that one did bounce. So unlike Tesla, that we were waiting and did not bounce, Clorox did bounce, and off it goes, and it bounced quite well, right? And since then, it's had a pretty good run from that time, right? This is almost like an inverted or reversed cup and handle. Typically, a cup and handle will have a big dip and then a smaller one, where in fact this one, I can grab this, maybe you can draw it in there. It makes this dip and then this dip. And so here's our cup and here's our handle over here, right? Little saucer below it. And, steam coming up off the, usually that's reverse. Usually it's the other way, where it goes like this, and then the handle on that side, and then it runs up from there, would be the idea behind a cup and handle. But still, the concept is still the same, in the sense that, we are seeing this bounce and a breakout of the resistance level, which is the important thing on the cup and handle play. So anyhow, just a little side note there. All right, just make sure I'm not missing anything on here. Okay, John, is this about short verticals? Yes, it is about short verticals. But one thing that's very important is talking about, like, these are stocks we're looking at. In order to place a short vertical trade, we have to find stocks to talk about, right? And I want to follow up on the stocks that I did talk about. And the other thing that's very important on short verticals is not just going out there and finding stocks and placing trades on the paper money software that we have, but also following up on those trades. And that's something I want to do right now. In fact, let's look at this. Let's take a look at, we got a couple trades. In fact, there's two of them in here that we still have going. We have NCLH and we have C. And we also had in here PG, which I closed out, and Amazon, which I closed out. And so, it's kind of interesting how, well, I wanted to wait and show you them, but somebody just had to take some plays on, or just, close them up. All right. And so let's look at these. Let's look at these two. Let's just see if there's anything to do with those. And then I'll bring up PG, and then I'm going to talk about Amazon just in a little bit because I want to cover something else in between. So, well, first off, let's look at Amazon. Let's look what happened there. Now, Amazon, what happened is, and this is going to tie into our earnings discussion with short verticals. Now, so I brought this up and I said, okay, let's place this trade. And this was on the 22nd that we placed a trade of January. And we noted it had an earnings. So you see right here, here's that earnings announcement. We said, well, can we still place trades in the earnings season? The answer at that point was yes, we can, but we just got to be mindful of earnings, right? And so I told everyone, hey, you know what? I'm going to look to exit that trade before earnings. And so this day it happened to drop down, and I got out of that trade. I closed that. So we sold it for 90 cents. I closed it for 95 cents. So we lost, it's basically a break even, just a slight loss on that trade, but got out of it right there. And not a minute too soon, right? Which right after that, it took quite a bit of a dive. Let's just see if we can see that. Let's see. It dropped down on us. Well, anyhow, it was 95. I'm not going to pull that up, but 95 cents where we got out on that one. And then another one that we had was PG. Come on. Let's see if we can bring that up. PG. All right. So here's PG. And this one, if you recall, we were looking at a double bottom formation, right? Hit once, hit twice, broke out right here, retest. And on that day, we did see the bounce. And, this is actually, let me remove this because I think you can see this now, that double bottom. But this is a really nice, not textbook. I mean, nothing is perfect, right? Nothing's exactly how you draw it out. But I mean, this one's pretty close. This one is pretty close to going, W pattern. In fact, I did a short on the W pattern, breakout, retest, run. Look at that, right? And so with this one, we sold 6 contracts on that for 48 cents each. And then, I drew this box in here, which shows us where we needed to be above. So we needed to be above this level by this time. This is where expiration is, right? So this was like next Friday is expiration for this one. But this one, I closed it out right here, and we can't see this. Let me bring this into our view here. So let me activate that. Closed out for 4 cents. Now, the question might be, excuse me, sorry. Why did I close out for 4 cents? Because it looks like it could potentially just go, right? Why don't we just let it go? I mean, to get max gain on this trade, it needs to be above this level. Whoa, above this level at expiration. I think it was a 145 or something we sold. Maybe it was a 146. Somewhere in there is something that we sold, whatever this level is, 147. Yeah, I mean 147 to 145, if I recall right. But, you get up here and you're like, well, why close it out? Because why don't we just let it go and let both of them expire worthless, right? Both legs expire worthless. We don't have any commission costs, all that stuff. And it's just happy city, right? Well, note at that time, there was still about 2 weeks. And so remember, I didn't close out there. I closed out right here, which at that time was about 2 weeks till expiration. And so there was still a fair amount of time, and there was really almost no more money. Sure, it was 4 cents, but really, in the scheme of things, there was very little to gain versus what we had to lose. Now, I want to compare and contrast that with another example, and this is very important on understanding how to deal with these earnings, or not earnings, but deal with these contracts and how do we manage them once we get in them, is looking back at, where's my positions? Here we go. Okay, so look at C right here, okay? Right now, down, it's profit loss is $150 from inception. Look what happened today, nearly $300 of loss today, right? When I opened up this up this morning, it was obviously about up $150, thinking, oh, hey, we have 8 days till expiration on there. So there's our days till expiration right here. 8 days till expiration. We're about a week out. What's the worst that can happen type thing, right? Let's go look at the chart on that. So let me bring up C and zoom in on this so we can get a little bit better feel for this. Let me let me remove these Fibonacci just so we can see the trade itself a little bit better. So we needed to be above about 112 at expiration, which, it still could be, right? But here's what I want to point out. We got in the trade right here. It was a nice return to support area, bounce off this support area. I think we had a moving average or something in there that we were looking for it to bounce off of. And it went sideways for a little bit and then it run up. And this is where we were up quite a bit on that trade, only to give it back in 2 days. Boom, 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 right? And even this morning, I could have closed out for even a slight gain, or even actually it was 150 when I looked a little bit later. It was like $40 or something. And then it just cratered. And so you can see how quickly we could go from making most of the money on that trade into a trade that we felt like this is pretty secure, it's looking good, to now being in the hole. So hopefully this is an example where I can contrast, what went well and what didn't go right, and show why we can walk away with a good chunk of the gain. And I've explained this before in this class, it's not always about just getting out how much distance it goes or how much time is till expiration. There's a combination of the two. Obviously, the further it goes, from where we sold it, obviously, the better our position is going to be, right? And the closer it's going to get to zero. But, also maybe it just drifts a little bit. And so maybe it's over in here and it's still looking good, but it's just, not where we expect it to be. And so, this one may wait a little bit longer to close out. We just want to close out earlier because we can take more of the gain here. And so there's not like, well, if I always sell for 30 days, day 20 or day 15, I'm looking to, exit. It's not just that simple. It has to be we have to be a little flexible combination of how far did it run? How much time is left? Is it doing what we expected it to do? All right. Was there a condition to close? I know I didn't have one on there. I didn't have one. And then part of the reason why is I do like to, I could put one on there, but I do like to close them out in class and just talk through and use this as a learning example. I mean, the whole idea here is that we're also supposed to learn what can make us better traders, right? And hopefully these examples are helping you do that as you see what happened with these trades. But let's go ahead. Let's go ahead and let's close this one out. I'm just going to do closing order again. I would have loved to close this morning. Oops, don't want that. Let me try that one more time. I missed that. Did I get them? Did I get it all? I think I did. Great closing order. Buy. Yeah, I did get them. Okay. Buy that. So we'll do that. 75 cents. We'll go ahead and confirm and send that. We're going to close that one out. It should fill here in a minute. And then let's look at the other one as well, NCLH. So that one's up. So let's talk about this one. It's up $51. And this one as well, we have 8 days till expiration, okay? So let's look at this, NCLH. All right. So what percent is that? Hi, Shane's. I'm not sure what you're asking about. Close when the trade gets a certain percentage. Okay, so close when the trade. This is what I'm saying. It's not necessarily a certain percentage. Some people will say, okay, when you get 80% of the gain, take it off the table, right? But let's just say if I could take 70% of the gain in 2 days, would that be a good idea? You see what I'm saying? Like, what if I had 20, 30 days, 40 days left? I can take 70% in 2 days because it just went well. So this is what I'm saying. There are times where you just say, you know what, boy, that trade went well. I can take most of the money right now. Maybe I'll just take it off now. But, kind of the general rule is just like most of it might be like 80%, when you get somewhere around 80%, 75, 80, 85%. The reason why we usually say around 80% or something like that is because as I was showing you with that trade on C, that last 4 cents will sit there and take forever. So sometimes that last little bit gets really sticky and it can be very difficult to wait to get 95%, like most all of it, right? And so it's the idea of taking the chunk when you can. Now, so looking at NCLH, this one's interesting because it really kind of didn't do what we expected it to do, what we expected it to do was rally and go up from here. It kind of went sideways. Now, this is the beauty between a long call and a short put vertical. For anyone who's been trading for a minute, that if you were to get in a long call and basically it went sideways, I mean, look at this. If this is where we got in, I'm not saying that's exactly where, but basically that's the day, you know, we looked to get in, it went sideways from where we got in. So if you go a couple days, you know, a week or two later and the stock's gone nowhere, you know, time decay erodes the value of that long call and it's losing money, right? However, with the vertical, this is where we get to benefit. We do have that benefit of time. Others are trying to get filled, benefit of time on our side. And so we got some, we have some benefit here where we can still make some money, but it hasn't done what we expected to do. We're starting to run out of time. I'm just going to go ahead and close that. And again, you know, kind of walking through the thought process of, you know, could it still do its thing? Well, sure it could, but that's not what we signed up for it to do. We signed up for it to do this, right? And the fact that we can, you know, almost be wrong because it did this instead and still walk away with a gain is what short verticals are all about. So let's go ahead and close that one out as well. So close that one. Let's see, now create rolling order. We want to create closing order. Rice Bird, how you doing? Good to see you. Now the question is, what is a green box? What is a green box? So the green box is really the trade basically. This don't look at the ceiling on this, but this is basically where we sold our strike. So at 22 was our short strike, and this is expiration. So those are the key levels on that. Is we want it above this line by here, and I just find it's easier to just draw a box instead of draw a bunch of lines on there. So we just want it in the green up there. Okay. All right. Now, so with that said, you know, as we're looking at this, these trades, let's go ahead and pull out some others that we could potentially look at and play some potential trades on. I looked over some different stocks, and let's look at let's see how this one's doing. KMB. Oops, I gotta get this off of that drawing tool. KMB. All right, so KMB is interesting. It reminds me a lot of that the PG trade, right? Where it really has kind of come down. Let me grab my drawing tools again. It's come down almost from a basing pattern. It's starting to roll back out. This has been a long basing pattern, starting to roll back up from that. And if we look back at where some of the resistance was on that and draw that in, you know, this is the old high. Oh, it's a little bit higher earlier. I would have liked that a little bit higher. This is the challenge of teaching, not at the end of the day, but near the end of the day, and not being able to wait to the end of the day. I was hoping it'd be up here. Nevertheless, let's still, this is a little bit aggressive, okay? But I'd like to see us close up here. But for this class, I do want to walk through and we'll place a trade on this. Yeah, let's just walk through this one and see where we're at. So, I mean, we're looking for it to be, what are we at? 108 or 109, somewhere in there is where that resistance. And again, I hope it does close up there because that would be more of the like the breakout that we're looking for. But sometimes when you got to teach class, it's not always the way you want it. So looking at days till expiration, we have 1, 8, 15, you know, looking for that sweet spot of around, you know, nothing's perfect, but maybe 30 to 50 days, enough time that we're getting some premium, but not too much time that, you know, we're not really getting the time decay benefit. So 36 falls right in there. So let's go out to the March 20th and we're going to scroll down and we're going to look for something with that, with the delta. Let's see, it looks like we got a 30 delta here or a 52 delta there. So it looks like the 105 is really what we're looking at here. It is paper money. Yeah. So everyone understand all these things I'm talking about is in paper money. So if we, you know, if we're going to go ahead and sell this 105, so let's go ahead and click on this. We get $1.85. I'm going to click on that. So we're bringing in $1.85. And then to protect that though, in case it goes south, we're going to sell this one. And that brings, what does that make it? A credit of 117. So I'm going to look to get just a little bit more out of that. I'm going to try to squeeze out 120. And you know what? Sometimes, you know, I'll place these just a little bit more, saying, you know what, I want just a little bit more out of that. And if it goes, it goes. If it doesn't, it doesn't. And that's okay. You know, it really is okay. So, you know, assuming we got a 5-wide spread. So again, we're selling the 105. And so someone can put the stock to us at 105. And we're buying the 100, so we can put the stock to someone else at 100. So the difference there is $5, which is our risk, but we'd keep the $1.20. And so the $5 minus the $1.20 is going to be $3.80. And we can do that in our head, right? And so 380 is our risk on that trade. So if we're bringing in $1.20 and we're risking $3.80, we're going to be close to about a 30%, 31, 32% risk reward on that trade. And some people look and say, okay, I'd like to see at least a 30 on something like that, and that would fall under that kind of idea. But how many contracts can we do? Well, we've been using $1,000 as our portfolio risk in this trade. And so if I divide that by the 380, it's $380 per contract, it's $3.80 per share, but these represent 100, shares, so it's $380 per contract. And so that's going to give us, I think it's going to give us 2, isn't it? Yeah, 2.63. So we're going to do 2 of those. And I'm going to go ahead and confirm and send. Look that over, make sure there's nothing wrong with it. Okay, we're selling it to open, bringing in $1.20 if we can get it. We'll look to make 240, risking 760. Okay, good to go. Send that off and see what happens. Now, this is what I would do, as I was mentioning with that box. So I'm going to go ahead and grab the drawing tool where I can grab a box, and I'll draw it from this out to February. Oh, I need to get some more room in there, don't I? So I need to get a little bit more room. To get more room, I'm going to come down. You see what I have these double arrows? I can change how much room I have to the right on that. So I can click on that, bring this up, and I'm going to type in let's do 100. That should give us plenty of time. Oh, that was too much time. We went way out there, didn't we? But here's what I want to do: is I want to adjust this to 320, right? So to give us an idea, 320 is going to be right there. So there's our expiration, is this spot right here. So what I like to do is just take the box to that point. I like to just take that over to there and, just drag this up. It really doesn't matter how high, just it's up there saying this is where I want it to be. It's just high, right? And so that's basically it. So now for me, it just makes it easy for me to then see it and go, okay, what's going on with this trade? Well, I just want it to be somewhere up in here, the higher the better, by this time. Does that make sense? Somewhere up in there by that time. And by the way, this is another thing I was looking at is as I kind of zoom out, or should I say pan out, probably think would be a more correct term, is looking at how it had a gap right here. And, sometimes if we can break above that, it could fill that gap. Now, again, it's a little more of an aggressive trade because it really hasn't closed up there. We haven't had the volume come in as we're breaking above that. But, hey, that's what we'd like to see. But for an example, that's what I want to walk through. Now, notice we didn't have earnings on this one, but some of these we will have earnings coming up, and that whoops, PANW is like looking at this one for bearish trade, but it has earnings here in 5 trading days, and so 5 days actually. That makes it difficult to do anything with, and so there's a couple things. In fact, I want to kind of discuss this for a second here. What can we do with earnings when we're placing short verticals? And there's some good and there's some bad, right? There's some things that can work in our favors. For instance, we do have, let me get that in there, come on. We have the implied volatility crush. And so if we're short, an option, if we're net short a trade, then that implied volatility crush can really, deplete or drain, the option value. And that's good, right? That's a good thing for us. It can also have a large directional move, and so that can make it, a winner pretty quick. And so that's a good thing. And so there are some good things with it, but it's not all good. And that's the challenge, right? And I'd like to hear what you think as far as the good and the bad, but just here's some things that I think is something to consider. Well, one thing that can go bad is the same thing, the large directional move, right? Which can also make it a loser pretty quickly. Another thing that can be a challenge is unpredictable. Unpredictable with that earnings announcement, right? We don't know exactly what it's going to do. And sometimes earnings, let me say G there, and sometimes it can go, even be a good earnings and the stock can drop, or sometimes it can be bad and it can jump. We never know exactly what it's going to go to do. And so that makes a challenge with the predictability of it all. And then also one thing to think about, if it moves into, so it's in the money, well, then we got to be considering, possibly the issue of a higher risk of early assignment. That increases. And so that might be something to be concerned about. So, so what does that leave us to do? What can we do then, as far as when we come into earnings season, and we're still looking to do some trades, right? So what to do? Let's just do what to do. Well, one thing we could do is simply avoid, what did you say, spread trading. Okay. And there's an argument for that. Is just not do it. But a lot of people don't like that idea, right? But there is an argument, and sometimes it's just not there. So the other thing is to trade, but exit prior. Got all the right words, but not the right typing. Exit prior to earnings. Now, and this is just like what I was talking about with that Amazon trade. I remember when I went to place that trade, a lot of you were saying, hey, earnings. The chat was blowing up with earnings. You got earnings coming up. I was like, yeah, I know. But you know what? As long as I get out of there. Now, there can be some downside to that in the sense that sometimes, implied volatility, as we can see here, is ramping up. And so that may not be necessarily favorable to our positions, right? Depending on where our strikes are, how much they're being impacted. Generally speaking, it's not favorable, but it's something that could still be traded. And again, I got out of that for basically a break even on that trade. And so it still allows opportunity, even though we scheduled this for whatever it was, like, I want to say it was like 6 weeks, 5-6 weeks, something like that. We don't have to be in the trade the entire 5-6 weeks. We can be in the trade, look for it to make the move. If not, if it just goes sideways or something, then, hey, hopefully time decay will help us out. And then we'll just exit the position, buy and sell back our legs and call it good, right? We do not have to necessarily trade it till expiration. Okay. And the third thing that we can do is we can actually change the strikes that we select to alter the risk reward. Okay. Make it more of a directional type trade. And so maybe it's not something we're looking for this probability where, we're saying, okay, I'm looking for a probability of 30%, but my risk is really high. My probability, my risk is high and probability is high, but I could change that and say, okay, how about we go with something that's, less probable, because that earnings is a wild card, but also, we're going to change the risk reward. In fact, let's go look at, like I was talking about, that PANW, right? Let's look at this. So PANW. I don't like the fact this is running up against a long-term support area, but we do have this kind of bear flag going on here where the stock has been dropping down from here to here. Let's see if we can draw this in. Let me actually zoom in on this a little bit too. And then it's flagging back like this. Everyone see that little bear flag in there? Okay. And so, if this bear flag does actually, play itself out, remove drawing. I want to duplicate the drawing. Go ahead and duplicate it. Then we're looking at to make a move to the downside. That didn't want to go. Maybe pull this up. Here we go. Now that'll let us drag that out and gives a target down in here somewhere, right? 128 could potentially be the target on that bear flag. And so let's go ahead and look at what this could set up, and I'll show you what I mean by selecting some different strikes. And so let's also look at the same time frame, that March 20th, right? And right now the stock is around 161. Now this would be a bear call spread because we're looking to be bearish on this. And so if we're looking around those deltas, we got a couple options here. So we could do a 170 possibly, like a 170, 175. And so let's say we were going to sell the 170. And then let me hide this for a second. And then I'm going to hit the control key. I'm going to push buy on the 175. And that gives us what? This gives us a trade where we have the 170, whoops, let's do 170/175 is going to give us a credit of what, $1.42. And we roughly have, according to this, what is that? What's the delta on that? A 32, okay, 32 delta. So we'll say a little over 30%. And the risk on that, that's a 5 wide strike, so $5. minus, let's move this up a little bit. So $5 minus the $1.42 is going to give us a risk of 358. Okay. Now, let's compare that with the 165/170, something like that. So if we go like 165, 170, and we go ahead and click on the bid on the 165, they're going to hide that for a second, hold down the control key, go and hit the buy on the 170, and this is going to give us a 240. Okay. So let's check this out. We get a credit of, I missed something in there. Yeah, I missed the E. A credit of 240, which means our risk, again, it's still a 5 wide strike. So $5 minus $2.40 is $2.60. And this one had a delta of 32, but this one has a delta of, what is it? 165 has a delta of 48. Okay. And so this is more like a 50-50, right? A 50-50 trade. And that's almost like matching up with an earnings announcement saying, hey, this could go either way. This could go up, this could go down. Well, now I'm almost playing it of, yeah, but that's kind of what I'm getting for it, is about a 50-50, return on risk, right? Versus something like this where I have a smaller return, a larger risk going into that unknown event. And so that can be a challenge on that. Now, so the question comes up, hey, straddle is potentially better around earnings and dealing with, volatility. I'm not, yeah, absolutely. I'm saying, there's all kinds of different plays that can be used, right? But this class is about short verticals. And so the question is, what can we do in this class with that, right? What can we potentially do? What are some things that can be altered to make more sense in the situation, the environment that we're in? And so we don't always have to just say, okay, well, we're just going to avoid it altogether, and we don't necessarily even have to, change it to make it work. Hopefully there's times where we can just exit prior, but sometimes we can avoid it and sometimes we can alter it. And so there's different paths we can take. So let me just leave you also, I'm going to wrap this up with just a couple more that I wanted to just address. Is BSX. This was interesting. Looking for this one, and I don't know if this one will come back by the time we talk again, meaning it could take a little bit longer, but looking for that dead cat bounce, looking for it to drop down, rally back up to resistance here, and then go down again. And so that's what I'd be looking for on this one. And I've covered the psychology of why that's the case. And again, in those shorts, I actually covered dead cat bounce and the whole psychology behind it. Why it tends to sell off when it comes back to this resistance level. So that's one we'll keep an eye on. We'll follow up on that one next time we talk. Another one is maybe Halliburton. So Halliburton got earnings over with, still in an uptrend, even on a day like today where it's still, where things have been coming down, most things have been dropping. This is one still holding up there, right? And so this could potentially offer up some opportunity. We talked about KMB. Let's see what else. DAL. Oh, okay. So we talked about bouncing off support earlier. This falls in line with what we talked about earlier. A stock that had a little dip below here, but this was a support level. It goes back a ways, and it bounced off this several times. Looking to see if this is going to bounce today or tomorrow or next couple days off of the support level and potentially head back up. All right. So, wow, a lot of stuff we've covered today. One thing, to keep in mind, again, please, like I mentioned, if you go over to the shorts, there you can find the dead cat bounce that I was talking about. If not, you can even, just from the home page even, you can just type in dead cat bounce. Cameron's done some on them. I've done that short, dead cat. And here's my short, 2 minutes and 15 seconds talking about the psychology and everything behind that. Cameron had a whole class on it. So please, check those out. And please, if you haven't done so, like and subscribe, like this, hit the thumbs up. It really helps us with our algorithm. It helps us get more of these classes out to you. It just lets us know what you're interested in and helps us spread the word. And so please do that and subscribe if you have not done so. If you've already subscribed, please don't do that yet. Don't do that. I'll just unsubscribe you. But if you have not done it, hit that subscribe button and you'll get some notifications. And again, it just helps us build our content and build our base. And so with that, hey, a lot of stuff we covered today. Thank you so much for joining me. We'll follow up on these next week, and we'll look for other potential paper trades to make. Until then, please leave comments down below. Let me know what you're thinking about. Let me know what topics are important to you. Can we enter an order to buy back the KMB as short? Yeah, you know what? I'll do that next time. Next time I'll talk about orders and how we can place orders to buy things back at certain spots, and that'll address those things. But yeah, so when we have different thoughts or questions, please leave them in the comments. I do read all of them, every one of them, and I'll reply to them and also look to incorporate them in our class. But until then, enjoy your week. We'll see you next time.